Risk-off is a term you hear thrown around a lot on Wall Street, but what does it really mean? Simply put, it's when investors get spooked. They start pulling money out of risky assets. They get very cautious. Think of it like this. The market is a roller coaster, and risk-off is when everyone wants off the ride. Now why should you care? Because risk-off sentiment can send shockwaves through the market. It impacts everything from stocks and bonds to currencies and commodities. Understanding risk-off is crucial for anyone who wants to survive and even thrive in the investing game. Ignoring risk-off is like playing with fire. You might get burned, but if you know what to look for, you can protect yourself and even profit when others are panicking. So buckle up because we're about to dive deep into the world of risk-off. What causes this mass exodus from risky assets? Let me tell you, there's no shortage of things that can trigger a risk-off environment. It's like a horror movie with a million scary monsters. First up, we have economic downturns. When the economy starts to sputter, investors get nervous. They see businesses struggling and jobs disappearing, and they hit the panic button. Then there are geopolitical tensions. Think wars, trade disputes, you name it. These events create uncertainty, and uncertainty breeds fear in the market. And let's not forget about financial crises. Remember the Great Recession? Those were dark days, and they serve as a stark reminder of how quickly things can go south. Central bank policies can also spook the markets. When central banks start raising interest rates or tightening monetary policy, investors get jittery. And of course, we can't forget about pandemics. COVID-19 showed us just how vulnerable we are to global health crises. Alright, so you know what risk-off is and what causes it, but what does it look like in action? What are the telltale signs? Well, during a risk-off period, volatility reigns supreme. The market becomes like a bucking bronco with prices swinging wildly up and down. Investors dump risky assets like they're hot potatoes. Stocks, especially those in high-growth but unprofitable companies, take a nosedive. Bonds, particularly government bonds, become the darlings of the day. Why? Because they're seen as a safe haven in stormy seas. Other safe havens include gold, the Japanese yen, and the Swiss franc. These assets tend to hold their value or even appreciate when the market is freaking out. Commodities, on the other hand, can be a mixed bag. Some, like gold, might benefit, while others, like oil, could get crushed. Section 4. Market tremors, impacts of risk-off behavior. The ripple effects of risk-off behavior can be felt across the entire financial landscape. It's like an earthquake shaking the very foundation of the markets. Stock markets, as we discussed, usually take a hit. But it's not just the magnitude of the decline that matters, it's the speed. When fear takes hold, sell-offs can be swift and brutal. Bond markets, on the other hand, often see yields decline. Investors flock to the perceived safety of government bonds, driving up their prices and pushing down their yields. Currency markets also experience increased volatility, with safe haven currencies like the yen and Swiss franc appreciating. Commodity prices can be more unpredictable. Safe haven commodities like gold might rise, while others like oil could suffer if a global recession is on the horizon. The key takeaway here is that risk-off sentiment creates a domino effect, impacting every corner of the financial markets. Section 5. Navigating the downturn. Strategies for risk-off periods. So how do you navigate the treacherous waters of a risk-off market? First off, don't panic. Remember, even in the darkest of times, there are always opportunities. One strategy is to embrace diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes. Consider increasing your allocation to safe haven assets like government bonds and gold. These can act as a buffer during market downturns. Another strategy is to look for value stocks. These are companies with strong fundamentals that have been oversold due to the overall market panic. Remember, risk-off periods can create buying opportunities for savvy investors. Just make sure you do your homework and invest in companies you believe in for the long haul. Finally, consider using hedging strategies like put options to protect your portfolio from further downside risk. Just be aware that these strategies can be complex and may not be suitable for all investors. Section 6. The bottom line. Adapting to risk-off for investment success. In the world of investing, risk-off sentiment is an inevitable force, like a hurricane that periodically slams into the market. Ignoring it is like trying to outrun a tidal wave. It's not a question of if, but when, risk-off will rear its ugly head. The key to success is to be prepared. Understand what drives risk-off sentiment, recognize its hallmarks, and have a plan to navigate its choppy waters. By adapting your investment strategy to account for risk-off periods, you can not only protect your capital, but also potentially profit from the market's fear. Remember, while risk-off can be intimidating, it's also an opportunity for disciplined and informed investors to shine. Now go out there and make some money.